know you're going to learn a lot watching this video. This is Chapter 18 of Accounting 202, Cost Behavior and Cost Volume Profit Analysis. I will review the highlighted learning objectives. First, we will look at the behavior of cost. A fixed cost is one that remains unchanged despite variations in the volume of activity, and this would be within what's called a relevant range. For example, $32,000 in monthly rent paid for a factory building remains the same whether the factory operates with a single 8-hour shift or around the clock with 3 shifts. This means that the rent cost is the same each month at any level of output from 0 to the plant's full productive capacity. When production volume and cost are graphed, units of product are usually plotted on the horizontal axis and dollars of cost are plotted on the vertical axis. Though the total amount of fixed cost does not change as volume changes, fixed cost per unit of output decreases as volume increases. For instance, if 200 units are produced when monthly rent is $32,000, the average rent cost per unit is $160, which is computed as $32,000 divided by 200. When production increases to 1,000 units per month, the average rent cost per unit decreases to $32, which is $32,000 divided by 1,000. The upper graph shows the relation between total fixed cost and volume and the relation between total variable cost and volume. We see that the total fixed cost of $32,000 remains the same at all production levels. We can also see that the total variable cost increase by $20 per unit for each additional unit produced. When variable costs are plotted, they appear as a straight line starting at the 0 cost level. The lower graph shows that fixed cost per unit decreases as production increases. This drop in per unit cost as production increases is called economies of scale. Variable cost change in proportion to changes in volume of activity. The direct materials cost of a product is an example of a variable cost. If 1 unit of product requires materials costing $20, total materials costs are $200 if 10 units are produced. And they're $400 if 20 units are produced, etc. While the total amount of variable cost changes with the level of production, variable cost per unit remains the same regardless of volume changes. Mixed costs include both fixed and variable costs. An example is compensation for sales reps that includes both a fixed monthly salary and a variable commission based on sales. Utilities might also be considered a mixed cost. Even if no units are produced, it is not likely that a manufacturing plant will use no electricity or water. Like a fixed cost, a mixed cost is greater than 0 when volume is 0. But unlike a fixed cost, it increases steadily in proportion to increases in volume. The total cost line in the top graph starts at the vertical axis at $32,000 fixed cost point. So at the 0 volume level, total cost equals the fixed cost. As the volume increases, the total cost line increases at an amount equal to the variable cost per unit. This total cost line is a mixed cost. So we're going to look at how to separate the mixed cost into the variable and fixed portions. A stepwise or stair-step cost reflects a step pattern Salaries of production supervisors are fixed within a relevant range. However, if production volume expands significantly, for example, they add another shift, additional supervisors must be hired. This means that the total cost for supervisory salaries steps up by a lump sum amount. Also, if production volume takes another significant step up, supervisory salaries will increase by another lump sum. This behavior is graphed here. So you can see how the stepwise cost line is flat within ranges called the relevant range. When volume significantly changes, the cost steps up to another level. Curvilinear cost also increase as volume increases, but at a non-constant rate. The curved line shows a curvilinear cost beginning at 0 when production is 0 and increasing at different rates as volume increases. An example is total direct labor cost. At low levels of production, employees can specialize in certain tasks. This efficiency results in a flatter slope. At some point, adding more employees creates inefficiencies. They can get in each other's ways or do not have special skills. The inefficiency is reflected in a steeper slope at higher levels of production. So we will treat stepwise cost as either fixed or variable. Curvilinear costs are typically treated as variable cost. So we're going to look at some ways of separating out the cost into the fixed and variable portion. One method is called the high-low method. So it uses an equation with 2 points to estimate the cost equation. We're going to look at the highest and the lowest volume levels. The high-low method will follow 3 steps. 1, identify the highest and lowest volume levels. 2, compute the slope, which is the variable cost. And 3, compute the total fixed cost. So here we're picking November and June as the high and low. So you can see we have the units listed and the cost. Then we subtract to get the change in activity. Then we take the difference between the high and the low volume and the high and the low dollar cost. And we divide the units by, we divide the cost, the change in cost. We divide the change in cost by the change. We divide the change in cost by the change in units to get a per unit amount. This represents the variable cost. Then we plug that into a formula to determine the fixed cost. And you can do this using either the high volume or the low volume. This example shows total cost at the high volume. So we took the per unit amount that we computed, 25 cents, times the units at the high volume, and then we subtract that from the total cost. So 31,000 minus 16,875 means that our fixed costs are 14,125. So now we'll look at something called contribution margin. Contribution margin is simply the selling price minus the variable cost. The contribution margin ratio is the contribution margin, again, selling price minus variable cost, and then we're dividing that by the selling price. And you can see the example here. So contribution margin is the amount by which a product's unit selling price exceeds its variable cost per unit. And you can see the example here. We have a selling price of $100, variable cost of $70. So the contribution margin per unit is 100 minus 70. The contribution margin ratio is the $30 divided by 100, which is 30%. We will look at break-even point for a single product company. So break-even is the point in the sales level at which the total sales equals the total cost. So that means the company is neither earning a profit nor incurring a loss. A key concern is whether a company will break even. They want to have sales at least equal to cover their total cost. So they are going to compute a break-even point so they can analyze their situation. So we're going to look at an example here using the formula method. So we're going to compute the break-even point where we have a company that has a $30 contribution margin and a 30% contribution margin ratio. To compute break-even point in units, we're going to take fixed cost and divide by the contribution margin. So 24,000 fixed cost divided by $30 is 800 units. We can also compute break-even in dollars. We use the same numerator, fixed costs, but now we'll divide by the contribution margin ratio. So 24,000 divided by 30%, or 0.3, means that we need to make $80,000 in sales to break even, so to cover our variable and fixed cost. If you looked at a contribution margin income statement, you would see that the income, net income, comes to zero. So we take our sales minus variable cost to get the contribution margin, subtract the fixed cost, which are equal to the contribution margin, and then we end up with a zero income. So we're going to look at some cost volume profit analysis. The first one is the margin of safety. This is the amount that sales can drop before the company incurs a loss. So it's usually expressed in dollars or as a percent of the expected sales. In this example, the break-even point is 80,000, and if they are expecting 100,000 as their margin of safety, so in this example, the company has a break-even point of 80,000. If their expected sales are 100,000, the margin of safety is $20. In this example, the break-even point is 80,000, and if their expected sales are 100,000, the margin of safety is 20,000. As a percent, the margin of safety is 20% of expected sales. Managers often use the contribution margin statements to forecast future sales or income. So we're looking at the relationship between sales, variable cost, contribution margin, and fixed cost. So they might ask a question, what is the predicted income from a predicted level of sales? So in this example, the company is expecting to sell 1,500 units. What is the amount of income if this sales level is achieved? Using this calculation format in the top graph, we can compute their expected income. So to find after-tax income from selling the 1,500 units, management has to look at the income tax rate. So if we're assuming an income tax rate of 25%, we can we can prepare a projected after-tax income statement. After-tax income is also computed as pre-tax income times 1 minus the tax rate. So if it's 25%, then it will be pre-tax income times 0.75. Management needs to assess whether this income is adequate or not. And they will also consider if sales and income can be increased or changed, or if they can reduce cost. So cost volume profit, or CVP analysis, is a good tool for looking at these different kinds of what if questions. So in this example, where we are looking at the dollar sales needed for target income, you'll recall that to get break even, we took fixed cost divided by the contribution margin ratio. So if we want to figure out what is the amount of dollar sales we need for target income, we add the target income to the fixed cost in the numerator and then divide by the contribution margin ratio. So we have fixed cost of $24,000. We want to earn $12,000 in income. So we divide that by the contribution margin ratio to get the dollar sales needed to earn $12,000 in income. We can do the same computation, but for units. So again, fixed cost plus target income in the numerator, but here we're going to divide by contribution margin per unit instead of the percentage. And this will tell us how many units we need to sell to earn the target income of $12,000. We can also use the contribution margin income statement to compute sales for the target income. So in step one, we're going to look at the fixed cost of $24,000 and the target profit of $12,000, and we're going to plug those numbers into the contribution margin income statement. And then we need $24,000 in fixed cost, and that will yield a target income of $12,000. So they must generate a contribution margin of $36,000, which is computed as $24,000 plus $12,000. So now we have $36,000 in the contribution margin row, and with a contribution margin ratio of 30%, sales must be $120,000, which is $36,000 divided by 30% or 0.3. So then we enter $120,000 in the sales row and then solve for the variable cost. So we have to take $120,000 minus $36,000 means our variable costs are $84,000. So this shows you a different way of computing it so that you can determine what are the dollar sales needed to earn a target income of X amount. Now we're going to look at break even for a multi-product company. So we know that most companies sell multiple products, and if that is the case, then we have to do a few extra steps in order to figure out the break even for all of the products. The sales mix is the ratio or proportion of the sales volume for the various products. So when the companies sell more than one product, we're going to estimate the break-even point by using what's called a composite unit, which summarizes the sales mix and contribution margins of each product. We're going to look at an illustration of a company called Hair Today, a styling salon that offers 3 cuts, basic, ultra, and budget, in the ratio of 4 basic to 2 ultra to 1 budget. So that's expressed as 4 to 2 to 1. Management wants to estimate break even for the next year. Unit selling prices are $20 for basic, $32 for ultra, and budget is $16. The unit variable costs are $13 ultra, $18 budget, and the unit variable costs are $13 for basic, $18 for ultra, and budget is $8. So using the sales mix of 4:2:1, the selling price and variable cost are as shown. So we have a unit contribution for basic of 7, ultra 14, and budget is 8. So we're simply subtracting the variable cost from the selling price. Okay, so using the sales mix of 4:2:1, the selling price of a composite unit is computed as shown. So remember 4:2:1, we're taking the selling price of each type of haircut times the sales mix ratio. And that gives us the selling price per cut using the sales mix ratio. So 20 times 4 is 80, 32 times 2 is 64, and 16 times 1 is 16. Then we're going to add those together. 80 plus 64 plus 16 equals 160. Their fixed costs are $192,000. The unit variable cost of the 3 products are 13, 18, and 8. So the variable cost for a composite unit is shown here. So again, we're going to take the variable cost for each type of haircut and multiply it by the sales mix ratio. Then we're going to add those together. 52 plus 36 plus 8 equals 96. So down in the lower portion, you can see the contribution margin per unit is the composite selling price, 160, minus the composite variable cost of 96. So the contribution margin per composite unit is 64. And now we can compute the break even in units and in dollars. So the break even in units will be the fixed cost divided by the contribution margin per composite unit. 192 divided by 64 means that we have to sell 3,000 composite units. So what does that mean? This shows how to figure out how many of each type of cut needs to be sold in order to break even. So again, we have the sales mix 4:2:1 times 3,000. So we need to sell 12,000 basic, 6,000 ultra, and 3,000 budget in order to break even. And this multi-product break-even income statement shows you computing those numbers where we do come out with a 0 net income. This concludes the recorded lecture for Chapter 18.